Hi, I'm Bob Eberly with Canzel Realty. Today on my channel, I have a guest, Bryan Clute. He is with House Capital, which is nationwide, and his office is located in Malta, New York. The reason I asked Bryan to come on today was to talk about interest rates and how they are impacting the real estate industry. Now, last 2 years, somebody put their house on the market, they were going to get 50 to 100,000 more than they listed it for if the house looked good. But that has now come back down to earth a little bit. People are still getting strong offers on their houses, but not like they were for the last 2 years. What has kind of slowed that down, I think, are interest rates. That's why I asked Bryan to come on. So Bryan, just give a quick little intro and then start telling us about the mortgage market and interest rates.
Yeah, absolutely. Bryan Clute with House Capital Saratoga, and yeah, it's no secret that the interest rates have gone up. They've gone up 7 times now. The Feds have raised interest rates anywhere from a quarter point, which is recently, all the way up to 3/4 of a point. Right, so they've been on a steady move here for the last year and a half, 2 years. It looks like we're climbing to the top of the mountain, hopefully. They did just raise the interest rates into the quarter point at the end of January. Looks like we're going to have another one, which is going to bring us up to 5% on the bank-to-bank lending rate. But it looks like hopefully that stabilizes things, and that's the top of our mountain or our plateau, so to speak. And my guess is, and smarter people than me that make more money doing this kind of thing, seem to think that 5% might be the cap that might level out, but it's gonna spend a little time on that level, right? So I don't think anybody's predicting, once we get to 5, we go right back down, right? It was spent, maybe a half a year, maybe a year, maybe a year and a half in that range before we start to taper down. So I don't necessarily think that it's something that's going to be fixed within the year or within, maybe a year and a half or so, right? There's some work that needs to be done once it gets to the interest rate to hopefully quell inflation. And, it's going to have to sit there for a little bit until rates start to get reduced. The good thing is now we see some things that are coming out. Just recently FHA released, this just happened yesterday, that their mortgage insurance rates are going from 85 basis points a year down to 55 basis points a year. So there's some things that are being put into place to kind of help home buyers, homeowners with purchasing down the road, which is great. First time home buyers will have a better opportunity with lower mortgage insurance rates to kind of combat the higher interest rates.
Are you seeing more first time home buyers or repeat home buyers?
We get a good mix of everybody, right? We get your first time home buyers, we get your people that are moving into the area, out of the area, selling, buying, and we still get a steady stream of investors. So people that are looking to buy multi-unit properties, people are looking to purchase and flip. So we get a steady stream of all walks of life, so to speak.
Okay. So as a realtor, and I know these tricks, but I prefer that you told them, what can a real estate agent do for their client when they are making an offer on a house to try to get this rate down? And before we talk about that, 6%, is that where it's at today for conventional?
Yeah, conventional is about 6.125.
Okay.
FHA is similar. I mean, they're about the same range. It really, there's so many things that go into it. So it depends on term, depends on credit score, and obviously, income, credit, and equity. Those are the 3 big things. But yeah, right around there. Yep.
I bought my first house in 1986 and paid 4 points to bring the rate down to 10.5%.
Right.
We were thrilled. We got 10.5.
It's all relative, right?
It is. And what I tell people is, you can create your own interest rate. You just change the amount of money you're paying on your loan payment. And because the interest rate is based on you keeping that money for 30 years. I always tell them, let's use $1,200 as an example. Not that anybody's mortgage payment is $1,200 anymore, but if that was, make it $2,400, divide that by 12, that's $200 extra a month. I'm sure most people blow $200 on stupid stuff, put it on your mortgage payment, and you will reload the back end of that loan till, if you do it consistently, you'll have the loan paid off in about 22 and a half years. So that's 7.5 years that you saved all that interest.
Yeah.
Right?
Yeah, for sure. For sure. Yeah.
Other than doing that trick, what else could a client do?
Well, I mean, they've released, and I don't want to say released because some of these programs already existed that were there for consumers, but the banks have been really creative about ways to offset some of that payment, some of that shock, right, for the next couple of years until interest rates go down. I mean, we've seen a lot of temporary buy downs, 2-1 buy downs, 3-2-1 buy downs. Okay, that's being used right now. So instead of, let's say your interest rate was 6.375, okay, or 6.25, let's you use a 2-1 buy down, so it'll start at 4.25 for the first year, 5.25 for the second year, 6.25, and continue at 6.25 thereafter, right? So it gives you an opportunity to have a low payment for the first couple of years, lower than you would otherwise have with the 6.25. It's going to give you an opportunity to refinance. So you see also a lot of tools that are happening now with refinancing, predicting where we're going to be, right? So I know I can only speak for House, but I know we have a program called House Shield, and what we do is we offer a refinance down the road for a potential home buyer right now. That's free of an appraisal fee. We cover the cost of appraisal. We cover the cost of settlement fees with the attorney settlement fee, and the underwriting fee. In New York State, you can take advantage of the SEMA program, where you only pay the mortgage tax based on where your old loan amount is compared to your new loan amount. So if you're just doing a straight refinance, that's not much of a difference there. You might want to roll some costs in, escrows, things like that, which are also going to get reimbursed from the purchase. So in reality, you can still take advantage of a low interest rate for the next couple of years and then refinance down the road when these rates come back down a little bit. There's other programs, adjustable rate mortgages, 3, 5, 7, 10-year adjustable rates. That's a little bit more risky than the buy down because at least the temporary buy down is fixed. But with the adjustable rate, they're fixed for a certain period of time and then it'll go adjustable. So it depends on where you feel the economy and the housing market's going to bounce back a little bit, how long you might want to take advantage of some of these programs, but they are out there. And like I said, with FHA just got a little bit more competitive, or might even be more competitive than a conventional loan. You might actually see some conventionally approved buyers gear a little bit more and go towards an FHA loan because the mortgage insurance is less and the down payment at 3.5%. This might really come into play with people that are buying 2, 3, 4 unit houses rather than putting 15 or 20% down. Home Possible allows for as little as 5% down on a 2-family, but the
First time buyer.
For first-time home buyers, right? But you might see a lot of people that would normally be a conventional buyer go to an FHA. This is definitely going to change, maybe in the real estate world, where there's been this hierarchy of cash buyers to conventional buyers to FHA buyers, where our government first-time home buyers have been on the bottom tier there.
Right.
Now you're going to see some conventional buyers actually convert to FHA because the payments are less. And you might see a little bit of a shakeup there, where you're going to see more FHA buyers. So your FHA buyers might be able to be approved more than they were before, right?
Yeah.
Especially with the mortgage insurance rates going down.
Right. Last couple of years, with the way houses were receiving, 10, 15 offers in 24 hours, if you were presenting an offer for a client with an FHA loan, they tell you, take a hike. We're not going to consider that. Because you're going up against either conventional buyers or all cash buyers.
Mm-hmm. Yeah, I've seen this resurgence of the I don't want to say subprime type loans, but we see the bank statement loans, the debt service coverage ratio, DSCR loans now, and when you put that together in a pre-approval, I mean, they're coming over as conventional loans, 20% down, 25% down. They're appealing to a potential seller, right? So there's nothing that states that those are income based off of bank statements, or if they're based off of rental income through a DSCR. So it's just another tool to use to win an offer in that kind of situation by somebody who's not even necessarily qualifying income. So it's there's definitely more tools at our disposal now, and for you as a realtor as well to kind of win these offers.
Yeah. Talk a little bit about sellers' concessions to
Yeah.
buy rates down.
Yeah. So seller concession is a great tool, and it kind of goes into these 2-1 buy downs too, and the 3-2-1 buy downs. Okay, because we can use that seller concession in order to buy down the interest rate to get them a lower interest rate, or to get them a lower temporary interest rate, to get them through this rough couple of years or a year and a half, whatever it might be. And utilize funds from the seller as opposed to the borrower bringing that cash to the table on a purchase. Obviously with FHA, we can go up to 6%. So a minimum down payment with 6% seller concessions is pretty much going to cover everything that we incur in New York State, and New York State is more expensive than most. But
And on a conventional loan, the seller concessions capped at what, 3%?
3% for minimum down payments. It does increase up to 4%, and then increase up to 6% once you have 20% down payment. And actually, there's an option for 9% somewhere down the road. So yeah, there's that option. VA doesn't actually necessarily cap. VA has a 4% cap on prepaid charges, which doesn't constitute the full closing cost. So a lot of people get stuck on, the VA loan can only have a 4% concession, but I can actually go a lot higher than that. Right. And USDA the same, 6%. So getting a little bit creative with these products too. Somebody might want to purchase in a certain area, but the payment's a little bit high, the interest rate's high. So maybe they go to a USDA, to a rural area, for the full concession, for the lower interest rate and the lower MI, right? The lower guarantee fees.
And agents should be looking at that USDA website, because sometimes you'll be surprised. I sold a house up on the hill in Cohoes, which is a city, and that was qualified for USDA.
Not every rural property is your rural property, right?
I bought the house with 0 down and financed his closing costs. I was like, I can't believe this even worked, but it did.
There's a good portion of Ballston Spa in the area that we're in that's USDA. Malta, it's USDA eligible. So there's it's pretty far reaching.
Just to recap, I mean, an agent should know about how to use sellers concessions, what type of loans are out there, what adjustable rates, because it sounds like there's a variety of those programs. And I have said this for years as a realtor: if you want to know how to sell houses, do what the car dealers do. What do the car dealers sell? They sell the money. If you watch their commercials, I got these cars, I got these cars. He doesn't care what car you buy. Just come in and buy a car. He'll get you the financing. That's why car dealers have finance people right in-house, so they get the person qualified that day, And the great question they always ask is, how much you want the payment to be? We're just going to stretch the loan out,
Well, there's a lot of ways you can get there, and I see those 40-year amortizations coming back. I see a lot of stuff that was kind of eliminated in 2008, and now it's coming back in. If the mortgage industry is anything, it's resourceful. So we'll find ways to get people into homes. It's just different products, right? As things change, we just have to adapt to it.
Right. What about credit scores? FHA today, what does somebody have to have as a credit score to qualify?
So FHA doesn't have a minimum credit score. Our investors start at 550. Okay. Anything under 580 is going to require a 20% down payment. Okay. So it kind of eliminates the benefit of FHA, but anything 580 below. And then anything over 580, we can qualify for 3.5% down. Also, you can do manual underwrites starting at that. So manual underwrites where we don't get an approval through our automated underwriting engines, right? DU or LP. We can utilize a manual underwrite as long as they have certain factors for FHA. So they have reserves, or they can show a 12-month housing history and on-time payments. They can show that their new mortgage is not exceeding their rent that they pay right now, right? So there's certain criteria where you can meet those manual underwrites where you don't even have to get that automated underwriting approval. And then everything 640 and above is basically the same, right? You get interest rates for somebody at 780 is going to be the same for somebody at 640 essentially. So it's an equalizer in a way with the government products like that.
Okay. Did I forget anything?
No, I mean, when we're talking about this and there's a lot of feedback to interest rates and how interest rates are causing people to get out of the market. But, you have to look at it relative to what it is and what it's compared to, right? So we're comparing somebody that's a first-time home buyer that's paying rent right now. Right. Mm-hmm. So, you take a $200,000 house, for instance, right? $200,000 house, your principal interest payment is $1,178 a month. Okay. Out of that, $989 is where you start an interest. Okay. That's a $200,000 house. Now, how much is it to rent a $200,000 house? Okay.
$1,800.
Okay. Yeah. So $1,800, right? So what are we comparing that high interest rate to? Yeah, the rates are high, but they're not as high as renting. Right. And that's really, where the focus has to be. I would think, rates. There should still be home buyers out there in the market, and there's still a reason to purchase a home. I mean, these houses, even on a conservative estimate, are appreciating 3 to 4% per year. Yeah. Okay, so you look at a $200,000 house that you buy, 2 years, that house is worth $217,000. Okay, you gain $17,000 in equity in 2 years, as opposed to renting where you've gained nothing, right? You've earned nothing there. So I think, once that point is driven home, there's still reason to buy a house. There's always a reason to buy a house as opposed to renting. And not to mention the fact that, these landlords have mortgages too, right? And they need to tap the equity in their properties. Okay. Right. So usually that's the asset that they use. That's their retirement. That's their assets, right? It's all on that property. So what are they doing? They're taking out home equity lines of credit, right? Where they're refinancing their mortgages to a higher rate. So they might have been at a 3, now they're at a 6. What happens then? They raise the rent, right? So now we have this situation where everybody's rent's being raised, and that only makes the difference even clearer, right, between renting and buying. So I think there's always a benefit to purchase and to be a homeowner in this country. So
absolutely, if you compare renting to owning that $200,000 house, taxes on that thing are probably about $4,000 a year. Call it $4,800, so it's even. That's $400 a month in taxes. You got to have insurance, but the thing about that is your payment is fixed. Yeah. 10 years from now, your payment's going to be the same. If you're renting at $1,800 today, 10 years from now, it's not going to be $1,800 anymore. Yeah,
and how about the fact that mortgage, that interest is tax deductible when your rent's not, right? So there's another benefit there. You start to put it into context of 2, 3, 4 unit properties, right? So if you're renting or purchasing let's say a 3 unit property, and you're living in it, and the other rents are, let's say, $1,200, which is reasonable around here. Okay, getting $2,400 in rent. What's that payment? Okay, that payment might be $1,800, you get $2,400 in rent. Now you're going from a situation where you're renting, you're spending money, it's not benefiting you, right? To now you've purchased an income producing property with FHA, 3.5% down, right? Same interest rates on a 3-4 unit as a single family. Okay. Right. So now you're getting that money in. You're not paying anything for your rent, you're living rent free. Okay. You're gaining money by owning the property, and you're still gaining $17,000 in 2 years, or 4%, whatever that is. It's a win-win. Even with high interest rates, it's a win. Even if the rates were 9-10%, it's a win. It still comes back as a win.
Years ago, I don't know whether it's still the same, but today I know it's still, you can buy up to a 4 unit with an FHA loan. And what we were always taught to tell people is, okay, buy a 4 unit as your first house. Mm-hmm. Live in it for a year or 2 years. You'll be living for free, right? Then go buy your single family house in the burbs. You can use another FHA loan because you're going from 4 to 1. Is that still correct?
FHA is a little bit stricter on it now. They want to see you moving 100 miles away, or they want to see some sort of change in your family structure, right? If you had a baby or something like that, you need a greater living space. But conventional is still along those guidelines. So what you can do is you can purchase that with FHA, and then when you purchase your single family residence, you get a Home Possible, a Home Ready, a Home One program, which doesn't require you to be a first-time home buyer. And you put 3% down or 5% down on those products. products, and you purchase a conventional, you purchase your single family residence with a conventional loan, or you continue to purchase, multi-unit properties that way and build a portfolio of properties
Right.
too.
Right. It's the fastest way to wealth.
Yeah.
Always has been, always will be. It's not the stock market. It's not crypto, although I mean crypto did have a brief run there for a while, but then it went in the tank. So
I mean, 3 to 4% is a pretty good return, but there's places out there that'll tell you, 12, 14%, right? And you put a little into the property and you get more out of it. So it's a great investment to have. Real estate's always a great investment. So
right. And some of the inner cities like Albany, Waterville, Cohoes, Waterford, Green Island, they sometimes have programs. If you purchase in their community, like I know when John McDonald was the mayor of Cohoes, he had told me about an incentive program that they had for reducing the amount of units you had. So if you took a 4-unit and cut it in half, they would give you the first year no tax. Second year, you'd pay a certain amount, and then it would gradually go up. So I think at year 5, you'd be paying the full amount of tax, and they reduced the density in the city. And density in those cities, these older cities that are on the river, like the ones I just mentioned, is a problem because, they have lots of kids usually. And not that having kids is a bad thing, but when you have those bigger families in there as tenants, it puts a strain on the school systems, the free lunch programs, the police, the fire, everything that happens, all the services in the city puts a strain on all of those things. So that's why they came up with, we need to have fewer people in our city. We can't handle all the people that we have. So that's why they did that incentive program to reduce density. I don't think that program's out there anymore, but there's other programs that municipalities come up with, their grant programs.
Yeah, so the grant programs, the down payment assistance is a huge thing right now, and it's really come into focus, right? So the city of Albany has that, the city of Schenectady has that. There's other grants that are out there. One of the best grants and what's happening right now with Freddie Mac that ties to the Home Possible program is called the Borrower Smart Advantage program, and they're giving grants up to $2,500. It really doesn't take much to apply. There's a small course that has to be done, but they're approving grants up to $2,500. So if you take, a $200,000 house, 3% down payment, okay, $6,000 in that situation minus $2,500. Now you're just bringing $3,500 to the table, and that's a non-repayable grant. So that program, that like I said, the rates are up, but there's these programs now that didn't exist before, right? So you take that 2,500, even if you're looking at a situation, let's say you're comparing a 6.375 to a 4.5, right? So if we feel like 4.5 should be where the market is or where a low interest rate is, right? So there's $165 a month in savings between those rates. All right. That's 15 months. $2,500 is 15 months worth of that $165. Okay. So you get that grant. Now you have 15 months to refinance down to that 4.5 and not really feel any kind of, issue with that higher payment, right? Because you got $2,500 in free funds. So it's just different ways to look at it, right? There's higher rates, but there's other programs, lower MI grants, things like that to offset that. So you kind of have to know how to work the system and find those programs that you need in order to offset it.
Right. There's more to selling a house than just telling them this is the kitchen. Welcome to the bathroom.
It's a service industry, right? And the more work you do, the more service you do, the happier your clients are going to be and the better programs you'll find.
All right, man. Thanks for coming on. And
thanks for having me.
And I'll put your info in this because this is going to go up on YouTube. So I'll put where they can contact you and me. And hopefully some people reach out to us.
That's great. I appreciate it.
All right, Bryan.
Thanks, Bob.
Have a good weekend. Bye.
You too. Okay.